Hello students, welcome to the lecture on receivables and inventory management. And after this lecture, we will be able to learn the following objectives. Understand receivable management, define objective of receivable management, explain credit policies of receivable management, discuss evaluation of the credit applicant, describe inventory management, define techniques of inventory management, and explain economic order quantity model EOQ. Receivable management. Let us start with what management is. Management of trade credit is commonly known as management of receivables. Receivables are one of the three primary components of working capital, the other being inventory and cash.
What we're talking about this week is managing your accounts receivable. These are all the monies that you put on account when a client does not pay for a service when they leave with their pet or when you leave the farm without collecting payment. So basically the logical model is that you do the work and you get paid and you walk out with a check. Or even preferably with the new wellness plans, you're getting paid before you're actually delivering. But in years gone by, and even to some degree today, there are still practices which run what's called accounts receivable. And so first thing I want to go over here is what's called the 1% rule. This day and age with people that are struggling a little bit financially, it's okay to have some accounts receivable provided it does not go above 1% of your gross income. That means less than 90 days of your accounts receivable should be no larger than 1% of your gross income. What I mean by 90 days is that you should be running your accounts receivable on a practice management software on QuickBooks so you can track it on the 0 to 30, 30 to 60, 60 to 90, and greater than 90 days. So we're talking about less than 90 days, that total amount should be less than 1%. Any more than that, and you've got too much money that's out there, and that starts to cramp your cash flow, especially this time of year when we're getting into the fall and winter months when the practice may slow down and you could use that cash flow coming in. Okay, so how to manage this? First of all, if you don't have any accounts receivable policy, i.e. the rules by which you're playing this game, you need to create policy in writing. If it's not in writing, then it becomes vapor policy. It becomes an idea and not actually something that's concrete and that the staff are going to follow. So it needs to be in written form. The best accounts receivable policy is that there isn't any, that everybody needs to pay when they collect, pay at the end of the services. Now, usually if you're doing a large animal work, like with producers, they might be paying at the end of when the cows are going to, when they get paid for cows or cattle or something like that. There's various, exceptions to the rule, but certainly equine clients will pay on delivery of service. You just have to train them that way, and it starts with creating a policy in writing. Small animal has done a much better job of this, and most small animal practices are less than 1%, but if you are above the 1% and you don't have it in writing, then get it in writing. Basically, everybody pays upon receipt of service. One thing that I did that I would suggest you do is that as a client is leaving, maybe they've dropped their pet off the day for dentistry, then you can query them to ferret out whether they know to remember to bring their checkbook or their Visa card. You can say, Mr. Johnson, before you go, how should I make the bill up tonight? How will you be paying so I can get your bill ready to go? You do it in a friendly manner, and you're just kind of ferreting out whether the client realizes they need to pay when they come to get their pet. So that's a tip for you right there. So number one, create policy in writing. Train your staff and the DVMs, not just the staff, but the DVMs that are in the exam room, that are presenting the treatment plans. The client needs to understand that the payment is due on receipt of services. Number three, start removing barriers for people to pay. And the best thing you can do is install a credit card terminal in the exam room, or have a wireless terminal that the technical person or the DVM, if you're doing the discharge, can run and get that. You can run the card right then and there, and then facilitate that smooth process so the client doesn't end getting their pet up front and having to wait and then having to pay. And by the way, don't discharge the pet until they pay. Another point of coordination there with your back-end team, that basically the client should arrive, the receptionist should pick up the phone and say, Mrs. Johnson's here to pick Teddy up, and so the tech team is starting to get Teddy ready to go and brushed out and cleaned up if need be. In the meantime, Mrs. Johnson will pay her bill up front with a credit card terminal either in the exam room or up front. Second thing here is put a credit card terminal in a truck if you're running an ambulatory practice with either equine or bovine, and be able to take credit cards. Many equine practitioners are doing this very successfully now. Initially, it's a little bit uncomfortable. Your equine clients may be in the habit of not paying, and you need to say, listen, if at all possible, it would be ideal if you could pay today. Would you consider doing that? And you'll find that 90% of them will do that. Where that runs into trouble if you're doing barn work and the client isn't there and so forth, but those are other arrangements you can make. Next thing is to have something like care credit to facilitate payment and make sure that the clients know about that. It's not something you want to be arranging at 5 to 6 at night when you're just about to close, okay? So great finances, great accounts receivable management is planned out, okay? There's good policy, the staff are trained, you've got easy ways that the clients can pay. And then finally, if you do end up with some accounts receivable, then send your statements out, and I would recommend you send them out twice monthly. Okay, this isn't a bill, it's a statement. So every, at the 1st of the month and the 15th, or the 15th and the 30th of the month, you've got to go into your management software, print accounts receivable statements. You put those in envelopes and put them out. The problem I have ultimately with managing accounts receivable is you've got to have extra staff to do that, and you're paying somebody anywhere from $10 to $16 an hour to manage your accounts receivable, and you're not making any more profit on it. So you're going to find that the standing ovation practices that are up in that 20% profit range manage their accounts receivables really tight. It's much more efficient for the client to pay right then and there than have somebody that's sending statements out. But that being said, if you do have to send statements out, send them out twice monthly and put them out on a different colored piece of paper. I prefer green. You could use anything so that it stands out in the person's mailbox.
Primary aim of receivables management went in minimizing the value of the firm while maintaining a reasonable balance between risk in the form of liquidity and profitability. Objectives of management of receivables are to attain not maximum possible but optimum volume of sales, to exercise control over the cost of credit and maintain it on a minimum possible level, to keep investments at an optimum level in the form or receivables, to plan and maintain a short average collection period. Works of receivable management. Pull business credit. They will look at how business has dealt with other suppliers and vendors. Pull personal credit. They want to ensure that not just one business is willing to and has demonstrated in the past that we will repay suppliers. Pull financials. Many suppliers will look at analyze financial strengths via supplied financial statements or tax returns. Important benefits. Efficiently managed receivables can free up funds and at the same time improve customer relationship. Reduction of funding requirements and interest expenses as cash flow increases. Reduction of days receivable outstanding, DSO, bad debt and receivable write-offs. Improvement of liquidity and free cash flow. Improvement of the customer communication and the customer relationship. Optimization in all elements of the accounts receivable processes. Credit policies of receivables management. A central element in developing credit management policy involves design choices on the extent to which credit activities are best managed internally or through specialist market intermediaries. A firm practicing lenient or relatively liberal credit policy, its size of receivables will be comparatively large than the firm with more rigid or signet credit policy. It is because of a lenient credit policy leads to greater defaults and payments by financially weak customers, resulting in bigger volume of receivables. A lenient credit policy encourages the financially sound customers to delay payments, again resulting in the increase in the size of receivables. Aspect of credit policy. A credit policy establishes guidelines that govern grant or reject credit to a customer, what should be the level of credit granted to a customer, etc. A credit policy can be said to have a direct effect on the volume of investment a company desires to make in receivables. Credit policy of every company is at large influenced by two conflicting objectives: irrespective of the native and type of company. They are liquidity and profitability. Variables of credit policy. The important variables of credit policy are credit standards. Credit standards refers to the minimum criteria adopted by a firm for the purpose of shortlisting its customers for extension of credit during a period of time. The quality of firm's customers largely depends upon credit standards. Analysis of customers is done under two aspects. Average collection period. It is the time taken by customers bearing credit obligation in materializing payment. Default rate. This can be expressed in terms of debt losses to the proportion of uncontrolled receivables. Collection policy. Collection policy refers to the procedures adopted by a firm creditor collect the amount from its debtors when such amount becomes due after the expiry of credit period. 5 C's of credit. All the 5 C's of credit are character. Character means reputation of debtor for honest and fair dealings. Capacity. Capacity refers to the experience of the customers and his demonstrability to operate successfully. Capital. Capital refers to the financial standing of a customer. Collateral. Collaterals are the assets that a customer readily offers to the creditor, that is, firm granting credit as a security which should be possessed by the firm in the event of non-payment by the customer. Conditions. Conditions refer to the prevailing economic and other conditions which can place their favorable or unfavorable impact on the ability of customer to pay.
The 5 C's of credit. Do you know what the 5 C's of credit are? This is what banking institutions and lenders look at and weigh when making a decision on granting you credit, and they're usually depicted by your credit bureau scores. The first C is character and can be defined as integrity, the quality of possessing and adhering to moral principles. In other words, your honesty. The second C is capacity. It's the ability to pay. You have to have the means to pay back a debt such as a car or a loan. You have to have enough income. The third C is capital. That's the assets of a business or an individual that remain after its debts and other liabilities are paid. In other words, don't be maxed out. Collateral is the next. Property or goods used against which would be lost in the event a loan is defaulted, such as losing your car or home if payments aren't made. Conditions is the final C.
Evaluation of the credit applicant. The goal of modern credit management is to evaluate customers' creditworthiness as precisely as possible and provide early warning of credit defaults. This requires software solutions which provide comprehensive support for the demands and core processes of credit and receivables management. Data collection and import comprehensive and up-to-date information about a firm's customers is the fundamental precondition for successful credit management. The Credit Management Platform. It provides data entry screens for credit managers to collect all necessary customer data such as master data, financials and credit limit requests. Risk analysis and determination of creditworthiness. Scoring models may be freely defined for the analysis of creditworthiness and limit determination. Credit and limit decisions. Any approval processes may be implemented, for example, to require the approval of a superior before changing a credit limit. Reporting and administration. All input data and output values, example, credit limits, are centrally stored and maintained in an electronic credit file. Monitoring and early warning system. The customer base can be continually monitored using freely definable business rules that define the criteria by which work list entries are generated. Simulations and impact analysis. Role models for customer scoring and creditworthiness assessment can be simulated using historic data before they are taken into production. Process management and monitoring. The credit management process is also subject to constant process optimization in order to make the most efficient use of available resources. Risk control and management. On the basis of data, a wide variety of analysis may be performed, providing comprehensive information regarding risk distribution within the portfolio, risk concentrations, or trend analysis among other areas. Credit terms. The receivables management of an enterprise is required to determine the terms and conditions on the basis of which trade credit can be sanctioned to the customers are of vital importance for an enterprise. As the nature of the credit policy of an enterprise is decided on the basis of components of credit policy. These components include credit period, cash discount, and cash discount period. Credit terms refer to the stipulations recognized by the firms for making credit sale of the goods to its buyers. There are two important components of credit terms. Credit period. Credit period is the duration of time for which trade credit is extended. During this time, the overdue amount must be paid by the customers. Cash discount terms. The cash discount is granted by the firm to its debtors in order to induce them to make the payment earlier than the expiry of credit period allowed to them. Cash discount is expressed as a percentage of sales. Credit control. Credit control is a complex process which costs both time and administrative costs. The function of credit control incorporates the following elements: checking customers' creditworthiness, prompt invoicing and follow-up, credit insurance, financial statements, and use of electronic data processing equipment. Checking customers' creditworthiness. This step relates to applicant's ability to pay for the goods or services opted by him. Prompt invoicing and follow-up. This is an executive action involving prompt issue of invoice and equally close follow-up action. Credit insurance. This point pertains to credit exports. Financial statements. Financial statement is an important document that presents desirable sources of information to the seller regarding the financial position of customer for credit control. Use of electronic data processing equipment. Electronic data processing equipment holds its own individual importance in providing timely and accurate information pertaining to the status of accounts. Inventory management. A significant example concerning inventory management is allocation of responsibilities and authorities. Inventory control problems can easily arise when, for instance, nobody in the organization is responsible for the inventory, or the responsible person has insufficient authorities to carry out the task.
There's little argument that controlling your inventory is critical to a successful practice, and we would also argue that it's impractical to do an effective job manually unless you increase the number and cost of your administrative staff. A good computer system can help provide the answers, but it's essential that your software has fully integrated tasks and management tools that help control your inventory. Simply recording issues and receipts is not enough. You need to use information technology to take the burden of repetitive tasks away from your staff. For example, why not use information technology to transfer details of orders and shipments automatically between you and your suppliers? It's proven to speed up the process, save time and avoid errors, as well as help optimize your investment in what you hold in stock. There are lots of factors you have to keep in mind when managing inventory. There's product ordering, receiving products, costing and pricing, charging out your inventory, tracking usage, establishing the appropriate stock levels, tracking and reporting on batch and lot numbers and expiry dates. And of course, there's establishing a process in your practice for handling all those tasks. And finally, training and supervision of your staff on your process. These have to be considered whether the inventory control is done manually or on computer. If all of them are not managed effectively, the end result will be poor inventory control and may not even justify the time and effort you've spent. Your practice management software can help by automating some of the tasks involved, often as a byproduct of other daily tasks. For example, the system should be set up so that invoicing an item will automatically deduct it from the stock you have on hand. Now, above all, the role of your staff cannot be underestimated. They must know all about your inventory management process and follow it. Breakdowns in inventory management often occur because management strategies and processes have not been clearly defined or adequately communicated to staff, or there are too many transactions and not enough time to perform the tasks manually, or the practice has no confidence in the tools provided by the software to manage the inventory. Most inventory management software can record items added to inventory and those removed from inventory as they're administered, dispensed, wasted, or returned for vendor credit, or they've somehow walked out of your practice by themselves. It should also show how many of each item are on hand at any given time, and help with automatic ordering, accurate reports, recording what items have been used on which patients, and calculating the amount of money you have tied up in inventory. By the way, government regulations in some countries in Europe require that you use barcode scanning to capture product batch and lot numbers and expiration dates on those items you carry in inventory. They also require that you show the batch and lot numbers and expiry dates on client invoices. In other countries, most practices only track that information for rabies vaccines and controlled substances. Due to the spread of infectious disease and product recalls, consultants predict that the more stringent regulations will eventually be introduced worldwide. It's important to understand that if you don't use the tools provided in comprehensive software, it will affect the accuracy of ordering, reports and usage tracking, etc. Veterinarians must decide whether to be proactive in inventory management. Will you anticipate regulatory requirements as well as look at the best processes that help improve patient care, increase efficiency, minimize risk liability, and improve profitability? Now an awful word, discipline, and that's essential for successful inventory management. Everyone must have a clear understanding that your process must be followed, no exceptions. Failure of all staff to follow the process can sabotage your system. How many times has a case of medication been opened and used before it's accounted for in inventory? And often veterinarians are the main culprits. Just one member of staff not following the process can destroy the value of the whole inventory system.
Objective of inventory management: protect the company against theft. Make sure that the only people in warehouse belong in warehouse. Establish an approved stock list for each warehouse. Order only the amount of non-stock or special order items that customer has committed to buy. Assign and use bin locations. Assign primary and surplus bin locations for every stocked item. Record all material leaving warehouse. There should be appropriate paperwork for every type of stock withdrawal. Process paperwork in a timely manner. All printed picking documents should be filled by the end of the day. Set appropriate objectives for buyers. Buyers should be judged and rewarded based on the customer service level, inventory turns, and return on investment for the product lines for which they are responsible. Ensure that stock balances are accurate and will remain accurate. Implement a comprehensive cycle counting program. Techniques of inventory management. Inventory management can be one of the most expensive aspects of running a business, but with proper techniques, we can reduce the inventory burden on bottom line. Just-in-time delivery. Just-in-time delivery or JIT is an inventory system that works to reduce the amount of inventory that a company will have on hand. Drop shipping. Drop shipping is an inventory process by which a company can sell a product to a consumer without ever having the product in inventory. Bulk shipments. Bulk shipping is an old staple of inventory management. The idea is that it is cheaper to purchase and ship goods in bulk, so we plan to replenish our inventory less frequently than we normally would. Record keeping. The basis for all inventory management is record keeping. Small companies may be best off keeping track of the inventory manually. Physical inventory. Physical inventory should be done at least once a year and as often as once a month, depending how likely items are to be missing. Cleaning out old inventory. Storing inventory is not free. Inventory represents an investment in a product or material. Mastering stock levels and inventory management. For dealers, keeping controls of parts and whole goods inventory can be tricky. Inventory overload. Many dealers have excessive amounts of parts and whole goods. Money that could or should be spent elsewhere is stuck on the shelves or in the showroom. Evaluate and purge. To get that idle inventory out of the way, dealers should evaluate which parts and equipment are needed and which are in less demand. Storage and monitoring. Once inventory has been whittled down, what's left should be well organized in a manner that allows for easy operation. Economic Order Quantity Model (EOQ). Managing inventory is an important task for every business that holds it. There are many costs that occur because of inventory that need to be minimized while still providing enough inventory to operate without losing customer business. The EOQ, Economic Order Quantity Model, is used to minimize these inventory-related costs. Calculation formulas. The cost of carrying inventory can be calculated by multiplying the cost of carrying a unit of inventory C by the average number of units carried Q, usually for a year. Carrying cost is equal to C in bracket Q by 2. To determine the number of orders, we simply divide the total demand D of units per year by Q, the size of each inventory order. Number of order is equal to D by Q. To determine the ordering cost, multiply number of order by the fixed cost per order F. Ordering cost is equal to F in bracket D by Q. The total inventory cost for a year for a business is simply the sum of the carrying cost and the ordering cost. Total inventory cost is equal to C in bracket Q by 2 plus F in bracket D by Q. Using calculus to determine the minimum point where the slope equals 0 will provide us with the optimal order quantity to reduce total inventory cost over the year. This is known as the economic order quantity. EQQ is equal to 2FT upon C 1 by 2. Summary. Now in the end, let us summarize what we have learned in this lecture. Receivables are one of the three primary components of working capital, the other being inventory and cash, the other being inventory and cash. The primary aim of receivables management went in minimizing the value of the firm while maintaining a reasonable balance between risk in the form of liquidity and profitability. The main purpose of maintaining receivables is not sales maximization, nor is for minimization of risk involved by way of bad debts. The goal of modern credit management is to evaluate customers' creditworthiness as precisely as possible and provide early warning of credit defaults. Inventory management can be one of the most expensive aspects of running a business, but with proper techniques, we can reduce the inventory burden on bottom line.